Welcome to Chapter 9, Managing Debt. In this section, we will cover understanding debt, the difference between good debt and bad debt, methods for paying off debt, and essential debt management strategies. Debt is simply borrowed money that must be repaid, often with interest. Common types of debt include various loans, credit cards, mortgages, and auto loans. We can categorize debt as either good or bad. Good debt, like mortgages, student loans, or business loans, can potentially generate future wealth or value. Bad debt, such as high-interest credit card debt for luxury goods, or loans for depreciating assets like some auto loans, offers little to no financial return. Key debt repayment methods include the debt avalanche, focusing on high-interest debt first, and the debt snowball, which starts with the smallest debt. Other options are balance transfers and debt consolidation to simplify and reduce interest. Effective debt management strategies include creating a repayment plan, cutting unnecessary expenses, and increasing your income. You can also negotiate with creditors, seek professional credit counseling, use credit sparingly, and build an emergency savings fund. Next, we move to Chapter 10, the importance of emergency funds. We'll define what an emergency fund is, why you need one, how much to save, and the best places to keep your money. An emergency fund is a financial safety net dedicated to unexpected expenses or financial emergencies. Key features are liquidity, a dedicated purpose, and providing peace of mind. You need an emergency fund for financial protection against the unexpected. It prevents you from incurring debt, reduces stress, and supports overall financial stability. A common recommendation is to save enough to cover 3 to 6 months' worth of your living expenses. Considerations include your monthly expenses, income stability, family size, and health or insurance coverage. The best places to keep your emergency fund are highly liquid and safe accounts, such as high-yield savings accounts, money market accounts, or certificates of deposit or CDs. Chapter 11 provides an introduction to investments. We'll cover an overview of investing, different types of investments, and the powerful concept of compound growth. Investing is allocating resources, usually money, to generate income or profit. The goal is to grow your money over time by taking calculated risks, often by foregoing consumption now for potential future returns. You should invest because it is essential for wealth building and achieving financial goals. Investing helps beat inflation, provides passive income, and is crucial for retirement planning. Common types of investments include stocks, which are ownership in a company, and bonds, which are loans to corporations or governments. Other types are mutual funds, real estate, and exchange-traded funds, or ETFs. Compound growth means earning returns on both your initial investment and your accumulated returns. This significantly increases investment value over time, especially when you reinvest returns. The Rule of 72 can estimate how long it takes your money to double. In Chapter 12, we dive deeper into understanding stocks and bonds. We'll define each, explain how the stock market works, and cover the basics of bond investing. A stock represents a share of ownership in a company. Key features include an ownership stake, the potential for dividends, and often voting rights. There are common and preferred types of stock. A bond is a debt instrument issued by a borrower to raise funds. Key features include a debt obligation and fixed income through regular interest payments. Bonds come in various types, such as government, corporate, and municipal. In the stock market, supply and demand set prices. The market involves individual investors, institutions, and traders. Transactions occur in the primary market for initial public offerings, or IPOs, and the secondary market, which includes exchanges. Key considerations for bond investing include the relationship between interest rates and bond prices, credit risk and ratings, and the bond's duration. The yield to maturity is another critical factor, and bonds are important for diversification. Chapter 13 explores financial risks and rewards. We will discuss understanding risk, the importance of diversification, and different investment strategies. In investments, risk is the potential for loss, while reward is the potential for gain. Generally, higher potential rewards are associated with higher risks. Types of risk include market risk, credit risk, and liquidity risk. Diversification is essential because it reduces risk by spreading investments across different asset classes. This helps offset losses, as not all assets perform the same way at the same time. Consider including stocks, bonds, real estate, and international investments. Short-term investments usually offer lower risk, but also lower returns. Long-term investments, conversely, typically involve higher potential returns, but higher risks. It is important to match your investment strategy to your time horizon. Market volatility refers to the price fluctuations in securities, often caused by economic news, political events, and investor sentiment. Managing volatility requires both diversification and a consistent long-term focus. Chapter 14 covers taxes for beginners. We will define what taxes are, explore different types of taxes, discuss why we pay them, and touch on the process of filing a tax return. Taxes are mandatory financial charges imposed by governments. They are mandatory contributions used to generate revenue for public services and facilitate the redistribution of wealth. Common types of taxes include income tax, levied on earnings, and sales tax, which is a tax on goods and services. Property tax is levied on real estate and other forms of property. We pay taxes to fund essential public services like education and healthcare, to maintain economic stability, and to redistribute wealth. Taxes can also be used to encourage or discourage specific behaviors. Chapter 15 focuses on understanding insurance. We will explore various types of insurance, its importance, and how the insurance mechanism works. Insurance is a contract that provides financial protection against specific losses. Key components include premiums, coverage limits, and deductibles. Its purpose is to manage financial risks by transferring them to an insurer. Common types of insurance are health insurance for medical expenses, auto insurance for vehicle damage and liability, life insurance for beneficiaries, and home insurance for property damage. Insurance is vital because it protects against financial hardship by covering the costs of unexpected events. It also fulfills legal requirements and provides peace of mind. Insurance works by pooling risk among many policyholders who pay premiums to the insurer. When a covered event occurs, the policyholder files a claim, which the insurer assesses and pays out according to the policy terms. Chapter 16 is about retirement planning for the future. We'll define retirement, explain why starting early matters, provide an overview of retirement accounts, and reiterate the importance of compound interest. Retirement is the phase of life when you stop working and rely on savings and investments. Key aspects include the end of active employment, achieving financial independence, and lifestyle adjustments. You should start planning early to give yourself more time to save and fully benefit from compound interest. This reduces financial stress, allows for better flexibility, and ensures more retirement lifestyle options. Common retirement accounts include the 401k plan, which is employer-sponsored, and individual retirement accounts, or IRAs, which can be traditional or Roth. Both have specific contribution limits and withdrawal rules. Compound interest provides exponential growth for your retirement savings over time. It is crucial for long-term wealth accumulation, reducing the need for massive contributions later, and protecting your savings against inflation.